All right, you guys have asked for some case studies. So this is a case study, and it's a really good one. It was so intense for me to actually create. I thought, okay, I could probably educate with this one. All right, so we have a client here. He thinks his value is 1.5. I looked it up. It's probably 1.2. Although he's got some upgrades that I haven't seen, so I don't know. It's possible it's 1.5. In any case, he thought he wanted a proprietary. He'd looked into some options. He's doing this for financial, smart reasons, so he can keep his assets under management. And what I wanted to show here is a couple of things. Had I just taken at face value what he wanted to do, he wants to take $100,000 for the next 5 years. And so that's line of credits. So are we going to do that through a HECM or through a platinum? Well, he had already told me he was very against the upfront fees. Oh, I've heard they cost a lot. And they're in a state where the other fees for recording are and the taxes are really high. So he's not wrong. If I had just taken the order, I would not have gotten this loan, I don't think. Or at least I wouldn't have serviced this client very well. So let's take a look at this. 100,000 cash, right? We're looking at the HECM on this side and platinum right here. This could also be the home safe. They look very similar right now. So this program requires you to take, I think it's 25%. So it's a little over what he had said. This one, I did exactly what he'd said. But the point here is the value has to come in at 1.5 in order to get this 500,000. He wanted 500,000. So immediately when I looked at the HECM, I was like, oh, we're short because of the max claim. But I don't know that we're actually going to get an appraisal of 1.5. So if we get an appraisal of 1.2, well, this number is going to drop drastically. And then what's the long-term equity position look like when we're looking at an interest rate of 11.4 versus 7.3? These are all really big factors. So we've got upfront closing costs, but there's no MIP on this proprietary. So like 20,000 at face value, if you don't know what you're looking at, oh, let's do this loan. But this is a reverse mortgage. So we can't just look at what it looks like to put this thing in place. We have to look at the long term. So within Quantum, when you do your simulation, I highly recommend these are the categories you want to create your simulation with. And here's the HECM. So I said, okay, I want to take 100,000 for as long as we can. And then obviously in year 4, that's run out. So in year 4, it drops down to 57. But the line of credit is growing at 7.8. The line of credit on the platinum was growing at 1.5. A lot of differences here. Hard to compare, but you got to do it. So then, okay, so we can almost meet his goals here, right? 100,000, 200,000, 300,000, 400, 457. So we are about 40,000 short of where he wanted to be. Not a terrible miss. But look at year 7. So we've used the mortgage for what we're going to use it for. Now we're just not doing payments. And the mortgage balance is growing because they're not making payments. Now, year 7, the equity position is 1.2. Hasn't dropped a whole ton, right? They've been able to borrow almost over 400,000, but the equity hasn't dropped 400,000. That's pretty cool. Let's take a look at how it looks on the platinum. Okay, so we have the initial. We've got to take 115 and then 100, 100. So 115, 215, 315, 415, 515, 530-ish. So that does get us a year longer, and it gets us not quite 100,000 more, but more. And it meets his goals a little better. However, doing this, I know that's not the only important thing. I know the long-term equity is important even for those people that say, oh no, we don't care. We don't have heirs, or we don't care if the heirs get anything, or we're going to stay here forever. A certain percentage of them, they're not going to be able to. So you need to protect your clients as best you can and at least let them make these decisions. Explain it. So we look at year 7 for equity. Oh my goodness, it has dropped significantly. Not just from the amount that we're taking, but now from the mortgage balance growing at 11.43%. Now, who knows what interest rates will do. If they go up, this would be worse. If they go down, it'll be better. But looking at this, is it worth the extra, I don't know, was it like 60,000 to do this loan to them if it costs that much in equity? Let's line these up next to each other. Check that out. 1.243 versus 982 just for an additional $60,000 upfront and to avoid those closing costs? No, that doesn't make any sense. Now, where it might make sense is if the appraisal comes in really high. I'll let you in on a tip. Go in for a HECM, and then if the appraisal comes in high, then you can switch it easier to proprietary. It's harder to go from a proprietary down to a HECM because of the FHA appraisal, because of the type of counseling. The companies all will work with you a little better. As far as I've heard, I haven't had to do this yet, but I think I'm going to do this on this file. So if the appraisal comes in at like 1.8, well, then the numbers are going to get even better on the proprietary. If they come in at 1.2, well, then the HECM's a win all day. So I just wanted you guys to see that. Make sure you're using the simulations and really doing an analysis for your clients, whether these people move forward or not. After seeing something like this, they're going to remember the reverse mortgage analysis I did for them, and I'll be the one they're referring. If they don't move forward now, but move forward in the future, they're going to be coming back because nobody else is doing this in-depth analysis to help them protect themselves long-term and meet their goals now. Reverse is just not transactional. All right, go get them, guys.